Robert Wetenhall to tell us about the wealth destruction that is the American housing market. Let me cut right to the chase. How much more down are house prices going to go?
I think next year there's a very high probability that housing prices decline between 5 and 15%.
Is that behaviorally in the market when you visit with Lennar or these others, or you talk to RBC clients? Are we framing that in our minds in the future, or is that going to be a surprise?
There's no change to our bearish investment thesis. The outlook is consistent with what we've been talking about. The supply overhang remains. We see nothing to really burn through that supply. We're still struggling with punk demand, high unemployment, low consumer confidence. There's nothing to really change the difficult course we're currently on.
We're going to nail this for the next 20 minutes. Dreaded first chart. You've seen all these charts before. I want to try to go deeper here, folks. Housing in search of a solution. What is the Wetenhall solution? Do you look at the housing market as two discrete markets, the foreclosure market and the non-foreclosure market, and the optimism is we're doing better over here?
The foreclosure market is the necessary way to cure the overhang, and you need foreclosed houses to come back to market at much lower prices. And those remarketed foreclosures will continue to exert substantial downward pressure on Case-Shiller.
Critical point. This is really, really important. You don't look at them as two discrete markets as the optimists do.
No, that's pie in the sky. You have to look at it on a holistic basis, and the fact is, home builders are competing against remarketed foreclosures that are selling at 10 to 20% below the new list price.
So your blended 5 to 15% center point tendency, 10% down includes foreclosures coming down, say 20, and maybe the others only go down about 8 or 7.
Unfortunately, that's correct. And the response by the home builders in this very weak demand environment has been to protect the margin performance of their companies. So they're keeping their sale price constant because they're really not getting that much benefit by providing any type of discount.
Right. Here's a chart here, folks. You've seen this before. It's an elegant chart, actually. It's a long-term view. Outside 2 deviations both ways. Okay, there's the trend back 30 years. There's the housing boom above 2 standard deviations. That blue line, the red line, is centered tendency. And we come down. And the important message for me is, are we going to bring that chart up again? Come on, Victor. Oh, there we are, the red line. Are we going to get back to that red line anytime soon?
I think that's a gross exaggeration in terms of the optimistic outlook that population growth will support household formation, which will drive the absorption of the excess inventory. And that is a legitimate...
Wait, hold on. We got to interrupt. Victor's working union scale. Get off that screen now, Victor, or we got to pay you an override there. Okay, go ahead.
So the problem with the idea that demographic growth will support household formation and accelerate absorption to work through the supply gut is legitimate, but the problem is home ownership rates continue to decline. And right now, home ownership rates have gone from 69% in 2007 to 65% currently.
Where are they going to be 5 years from now?
I think in the low 60s, 62% is a possibility. And that factor is overlaying such dramatic pressure in terms of the demand profile for the buyer.
Should I invest in rental property if we're going to go from 69 to 65 to 60?
I think that's the wave of the future. And people are willing to pay higher rent relative to the cost of home ownership because it provides incremental flexibility to the consumer. And do you want to make an investment in a leveraged asset that can decline in price a year from now? Most people don't, particularly given the economy.
Another chart here which shows where we are. I want to talk to you now as an economist. Real residential regresses to 1991. It's like a Tom Purcelli kind of moment. There it is, real inflation-adjusted residential construction. Do you agree with many, including Dr. Zandi over at Moody's, that we've just got to have housing participate to get good nominal or good real GDP?
Unquestionably. And you need some kind of dramatic improvement in the housing market for GDP to pick up because it's a very substantial component. And without a housing market solution, you're not going to have a broader economic solution.
Housing wasn't really mentioned at the IMF in defense of Carlo Cottarelli. The Fiscal Monitor had a number of nice pages on Fannie Mae, Freddie Mac. Why aren't we talking more about clearing the housing market? I mean,
it's a big problem,
and isn't it?
It's a politically unpalatable solution. The current administration has failed to demonstrate any concrete manifestation of how they would resolve it. So it's kind of like a hot potato. Nobody wants to deal with it. What will work is if you're able to bring employment back down to 7% or 6%, you can increase consumer confidence.
Without the housing component, C plus I, that investment component, can you get down to 7% unemployment if you don't have that I working for you?
I'm skeptical. And I think the problem is the tail's wagging the dog at a certain point, and this is not going to work unless we can get the macro backdrop to help housing market out specifically.
Robert Wetenhall with us, RBC. We're going to come back a bit more optimistic. I think Dr. Harris would say relatively optimistic versus your gloom. How do we efficiently clear our foreclosed market?
I think we are, but it's going to be a multi-year process. And the real question, to tie back to what we were talking about earlier, you need housing to recover for the economy to improve, to get people back to work. And what's that going to take? You're going to need starts to accelerate. And the big question in the marketplace that stock investors want to know is, when do we get to 1 million new home starts? And I think that number is going to be 2015. So we've got another 4 years of hardship.
Don't tell that to the politicians. Look at this. I mean, why lend incentives? Okay, here's one of the incentives. It's the inflation-adjusted 30-year fixed mortgage, which is, back 10, 12, 15 years. We've never seen cheap money. That's not doing it, is it?
It's a precondition for a recovery. By and in of itself, it's inadequate. And the problem is we've had really low high degree of affordability, low interest rates now for a bunch of years. And the problem is it's failed to drive the demand. And the problem is people are very vocal in it. They want to rent as opposed to own. And this switch is swamping out these other good things the government has tried to do, like keep rates affordable. But it's not working in practice.
Victor, wander over here if you can. I know it's a long walk for you after that New York Jets loss. But here's existing medium home price. Here's the boom. Here's the linear function. Up we go, the boom. They all look the same. And here we are. We're noodling around here at 168,400 on existing home sales. You're saying that's going down $16,000?
That's realistic. That's realistic in the next year.
In the next year, so we get to 150,000 to use a round number. Will that shift the rent-to-own dynamic?
That starts to make the dynamic more favorable. And effectively, that's the break point at a certain level, and it depends on which city you're in and which region you're located. All of a sudden, the consumer will say, houses are so affordable, I'm better off buying the house, making the long-term financial commitment, taking advantage of high degree of affordability, and that is what's the necessary condition to start to address this problem.
I'm going to give credit to Alan Meltzer, but if we're talking about payroll tax, and Marty Feldstein wants to cap tax preferences, all those free goodies some people get, the haves get in America, why can't we do a tranched payroll tax-like mortgage incentive where if you make up to so-and-so, you get to take 140% of your mortgage deduction, and if you make more, you take less? Is that like, am I on the edge of common sense here?
Science fiction, my friend. It's just too far out of the range of what people can deal with right now. The one thing we do have a reference point of is the first-time $8,000 homebuyer tax credit. Caused a big surge in demand in the first half of 2010. And what it did is it pulled demand forward into the first half of last year. The second half of last year was atrocious. As a result, the publicly traded home builders had huge distortion in their order patterns, and they everybody will admit this, rather had no government interference, because ultimately you got to pay the piper somewhere in the process.
Here's a chart. Too much information. We're all housing here. We're going to talk Europe in the back half. Too much information. Construction. This is just nominal construction. The charts all look the same, but it gets you back to 2000. It's absolutely remarkable. To me, this is part-time jobs, full-time jobs. Some of that is that immigration inflow, picking that up. When RBC, when you and Tom Porcelli, Michael Clorty, and the others, when you filter this all through, how much of getting from 9% to 7% unemployment is about housing? Is it a 100% correlation, or is it, say, 2/3 of that move?
The only way I can answer your question is that historically, since 1991, the correlation between unemployment, consumer confidence, and new home starts has been 90%. And that's been a pretty consistent historical correlation. So I think all three of those things have to improve. You can't have one without the other. So I don't know, in terms of the construction level, if you can put a specific data point out there and say, this will fix the problem, this addresses it, this is sufficient. But overall, you need those three factors to move in tandem.
Do you have a single best buy, or do I say it's a Wetenhall single best hold, or is it a single best, well, don't sell this, but we don't like it either?
Home builder stocks are washed out, very attractive valuations, no catalyst to the upside. What do I prefer? Own building products, great idea right now in this market. Owens Corning. It's a building products company with a lot of upside to emerging markets. And I like the growth profile in the BRIC countries over Europe, obviously, and the U.S.
This is the Pink Panther.
Pink's good, gaining market share in the insulation business.
Is that what they do? What portion of their business is
It's
Pink?
around, think of it as a third. Insulation business, which is suffering, obviously. World-class roofing business, worldclass composite business. Very
An emerging market play.
Not
okay. We get a ton of mail when you're on. People love you because they, all the elites hate you, and everybody else I talk to loves what you're talking about because they're living it out there.
I appreciate kind of you to say.
Negative 10%, 1 year out house prices.
That's the call.
They're killing me. Robert Wetenhall, go away. RBC Capital Markets. Okay.